Hello everyone, welcome back to Fundrise Finance. The month of November was pretty good for the markets overall, with the S&P 500 gaining over 5%. But from then, what we saw was a gradual decline in the market, close to 4%, pulling us back to where we were end of October. Overall, year to date, the S&P 500 is down almost 18%, and effectively, since mid of November till now, the market has been pretty much flat, down just over half percent. With the market still in such turbulent mode, in today's video, we'll look at 5 stocks which I feel are still undervalued at the moment and offer a very good buy point. So let's check it out. But before that, let's give a quick look at how our dividend picks for November have done in the last 1 month. We had Medtronic, Abbott Labs, Lowe's Companies, Microsoft Corporation, and Cisco Systems. In the last 1 month, Medtronic has been the worst performer of this all, down 1%, while Abbott Labs gaining just over 8%. Similarly, Lowe's companies over 8%, Microsoft over 9%, and Cisco doing the best over 10% returns in the just last 1 month. Now, with that said, let's quickly dive into the dividend picks for the month of December, where we will see a few of these repeating. To know which are those, do check out this video till the end. The first stock on our list is A.O. Smith Corporation, ticker symbol AOS. A.O. Smith is from the industrial sector and provides water heating and water treatment solutions. Year to date, we see A.O. Smith take a real good beating, down over 30%. The last 1 year, down almost 30%. It has a market cap of just under $9 billion and currently yields 2.06% and a forward PE of almost 19. From a dividends perspective, A.O. Smith has been raising its dividends for the last 28 years, which makes it a dividend aristocrat, which means A.O. Smith is part of the S&P 500 and has been raising its dividends consistently for over 25 years. The 5-year dividend growth rate is really amazing, over 15%, which is twice the current inflation. This is really good, which means that your dividends are not losing their value to inflation. The payout ratio is also amazing, just under 36%. Valuations wise, Morningstar considers A.O. Smith a 3-star stock with a fair value of $67.12. Value Line has a midpoint target price of $78. CFRA has a 12-month target of $60, while Zacks has a 12-month target of $52. As for my own calculations, which considers current and historical yields, I found A.O. Smith to have a fair value of $61.46. Averaging these 5 values, we get a final price of $63.72. That makes A.O. Smith undervalued by 9.29% with a fair value of $63.70. So the second dividend stock on our list is Lowe's Companies, ticker symbol LOW. Lowe's is from the consumer discretionary sector and is a home improvement retailer. Year to date, we see Lowe's falling more than 21%. In the last 1 year, almost down 22%. In the last 5 years, though, it has returned an impressive 137%. Lowe's has a market cap of $122 billion and currently yields 2.08% at a forward PE of 14.62. From a dividends perspective, Lowe's has been raising its dividends for the last 59 years. That makes it a dividend king, which is an exclusive group of companies who have been raising their dividends for more than 50 years. The 5-year growth rate is also an amazing 19.47%. It's again more than twice that of the current inflation. The payout ratio is really good, just under 28%. From a valuations perspective, Morningstar considers Lowe's a 3-star stock with a fair value of $218. Value Line has a target of $238. CFRA has a 12-month price of $240, while Zacks has a 12-month target of $221. As for my own calculations, I have Lowe's at a fair value of $247.48. Averaging these 5 values, we get a final average value of $232.90, which makes Lowe's undervalued by 15.43%. The third stock on list is Target Corporation, ticker symbol TGT. Target is also from the consumer discretionary sector and is a general merchandise retailer in the United States. Year to date, we see Target falling almost 35%. In the last 1 year, almost 36% down. In the last 5 years, though, it has returned an impressive almost 150%. Target has a market cap of $70.10 billion and currently yields 2.84% at a forward PE of 27.53. From dividends perspective, Target is also a dividend king, which has been raising its dividend for the last 54 years at a very impressive 5-year dividend growth rate of just over 10%, which is higher than the current inflation. The payout ratio is also good, just under 52%. From a valuations perspective, Morningstar considers Target a 4-star stock with a fair value of $177. Value Line has a target of $202. CFR has a 12-month price of $162, while Zacks has a 12-month price of $174. As for my own calculations, I found target to have a fair value of $191.83. Averaging these five prices, we get a final average value of $181.37, which makes target undervalued currently by 19.10%. The third stock on our list is Taiwan Semiconductor, ticker symbol TSM. As the name suggests, Taiwan Semi is from the information technology sector that designs and manufactures semiconductor devices. Taiwan Semi was in the news recently when Warren Buffett's company Berkshire Hathaway bought $4 billion worth of stock. Taiwan Semi was in the news recently where it was increasing its investment in the Arizona plant by $40 billion, and companies such as Apple have agreed to use their chips built in the Arizona factory. Taiwan Semi has a market cap of $406.89 billion and currently is 2.32% at a forward PE of just 12.49. Dividends perspective, Seeking Alpha shows TSM to be raising its dividends just for last 1 year, but I think that's incorrect. The 5-year growth rate is an impressive 10.18%, the very low payout ratio of just below 6%. Taiwan Semi has its ex-dividend date coming really soon on December 15th. So all the shareholders of Taiwan Semi before this date will have the dividends paid on January 12th of 2023 at 45 cents per share. Valuations perspective, Morningstar considers Taiwan Semi a 5-star stock with a fair value of $133. Value Line has a target price of $91, while CFRA has a 12-month target of 87. As for my own calculations, I found Taiwan Semi to have a fair value of $90.66. Averaging these four values, we get a final average price of $100.42, which makes Taiwan Semi undervalued currently by 24.45%. The fifth and final stock in our list is Medtronic PLC, ticker symbol MDT. Medtronic is from the healthcare sector that develops, manufactures, and sells healthcare equipment to clinics and hospitals worldwide. Year to date, we see Medtronic falling almost 26%. The last 1 year, Medtronic has been down more than 30%. Medtronic has a market cap of $104.54 billion and currently yields 3.46% at a forward PE of 14.91. From a dividends perspective, Medtronic has been raising its dividends for the last 8 years at a 5-year dividend growth rate of just over 8% and payout ratio below 50%. Medtronic also has its ex-dividend coming really soon on December 20th. So all the shareholders of this company before this date will have the dividends paid out on January 13th, 2023 at 68 cents per share. Valuations perspective, Morningstar considers Medtronic a 5-star stock with a fair value of $112. Value Line has a price target of $106. CFRA has a 12-month price target of $104, while Zacks has a 12-month price of $91. As for my calculations, I found Medtronic to have a fair value of $107. Averaging these five values, we get a final average price of $104. That makes Medtronic undervalued currently by 32.33%. Summarizing all the dividend picks that we discussed today, we have Medtronic PLC, Target Corporation, A.O. Smith Corporation, Lowe's Companies, and Taiwan Semiconductors. As you can see here, among all these five, Medtronic and Target have been in the negative over the last 1 month, while A.O. Smith and Lowe's have returned below 10%, while Taiwan Semi has returned the best of these, returning over 24%. So as we just saw, all of these stocks are currently undervalued by anywhere between 10% and 35%. So each of these offers a very good buy point right now, which I think we should capitalize on. Like I always say, as long as we buy stocks which are undervalued, given all things considered, all the fundamentals are good for those companies. Such undervalued picks help generate good returns in the long run. Hope you like this video and found it valuable. I would really appreciate if you could hit that like and subscribe buttons. That would help YouTube suggest this video to many more out there, and that would help this young channel. And until we meet in the next video, let's try to do as much as possible to be financially healthy. See you. Bye.